morning. You're all most welcome to our fourth webinar of the Banking and Financial Services Awareness Month. Thank you indeed for taking the time to be with us this early morning. That shows that you really have the passion and interest in ensuring financial wellness. Your money can. That's our campaign slogan. Be money smart. Sente yo sobola. The whole campaign, the entire Banking and Financial Services Awareness Month is about making getting people to get money savvy, be clever, be prudent, be smart about their money. We say your money can, be money smart, sente yo sobola. We have a number of platforms so you can get in touch with us on Twitter, #YourMoneyCan. Please reach us and let's engage. Visit our portal at www.yourmoneycan.or.ug. Ronald Mugwanya is my name. I work with the Institute as a training and partnerships executive. This campaign is brought to you by the Uganda Institute of Banking and Financial Services in collaboration with a number of partners. We've got strategic partners, the Bank of Uganda, and Financial Sector Deepening Uganda, FSDU. We've got platinum sponsors, which is the Bank of Africa, Uganda, as well as multiple sponsors from across the commercial banking fraternity within the country. We've got a number of organizations, Finca Bank, Cairo, Equity, Pride Microfinance, DTP, Yogford Microfinance, Stanbic, Opportunity Bank, and so many others. Today, in this session, dear participants, we are discussing family and money. This is a topic, it's a very contentious topic, it's a very contentious issue. Many people don't want to talk about it. Money and stress actually go hand in hand. Indeed, some organizations have researched the issue of money, and here we'll talk about the American Psychology Association. In their survey of 2014, they said that money is consistently among the top sources of stress for individuals year after year. It's a never-ending issue. Parents of teenagers, in this case, are more likely than adults with no children to actually have higher stress levels. Okay, I've been reminded we've got a very important partner here, that is Summit Consulting. I'm sorry, Summit, if you are listening in. It wasn't intentional, I just forgot. Summit Consulting are also key partners in this, and they've been giving us a hand, all through the campaign. My apologies, Summit Consulting and Mr. Strategy in particular. What we're saying here is that families with children actually have very high financial stress levels. The survey actually indicated that 18% of respondents say money is a taboo. They just never talk about money. And we all know about this to be true, because in the communities where we've grown, you find that man and woman never discuss money. And in many cases, if dad is taking out money for anything in the house, has to go somewhere, probably in the bathroom, in the toilet, or hide somewhere with a colleague to take out a 10K or even less, so that mommy could probably buy something. Now, for purposes of this particular webinar, this is actually the taboo, the myth that we want to demystify, the myth we want to take head on. And it's for this purpose that we have invited our very special guests, two very, very, very well-informed ladies within the banking and financial services sector. And the people that I'm about to introduce. I will start with our first panelist, Head of Institutional Banking at Opportunity Bank Uganda. She has had a career as a banker for 15 years. This person is Lucy Kabalisa. Now, Lucy has covered a broad range of businesses. She is currently heading institutional banking at Opportunity Bank, like I've just said. And prior to joining Opportunity in May of 2017, Lucy spent 12 years at Centenary Bank, where she began her career in 2001 as a banking officer. She rose through the ranks to branch supervisor, branch accountant, regional supervisor, and branch manager. Lucy is a financial literacy trainer, a sales and relationship management expert, and we are about to hear and sharing her experience and expertise regarding the issue of money and family. The other panelist I'm to introduce is Alice Matama. Alice is the sales manager, is the savings manager at Hugford Microfinance Uganda Limited. She is a very well-learned person with a BCom accounting degree from the University of Makerere and a postgraduate diploma in business administration from the Uganda Management Institute in Kampala. She has attended professional training courses, which include Bank of Uganda Training for Trainers course in financial literacy, digital financial services at Boulder MFT Turin, Italy. She's a community-based microfinance. She also attended community-based microfinance courses at St. Francis Xavier University and Gwanish in Canada. Her performance, she also has programs in high-performance microfinance at schools from the School of African Microfinance, Mombasa, Kenya, as well as attending administrative law at the Law Development Center here in Kampala. Alice has 10 years experience in microfinance banking, specializing in savings mobilization, community-based microfinance, and treasury management. A teacher and a performance coach and mentor, Lucy holds a BA degree in administration and management as well from the Uganda Martyrs University in Kozi. She lives with her husband, Dennis, and 2 children. In her spare time, Lucy enjoys prayer, reading, and helping through ministry as well as training, which is why she's here today. Now, ladies and gentlemen, without taking much of the time, I would love to invite our first panelist, and this is going to be Lucy Kabalisa, the head of institutional banking at Opportunity Bank, Uganda. Lucy, you are most welcome.
Thank you very much, Benedict, and our dear listeners and viewers.
Just a bit of correction, Lucy. I'm Ronald.
Ronald.
Yes. Thank you very much. Yeah.
We take this opportunity as well at Opportunity Bank to appreciate the Institute and all the partners for this initiative of discussing pertinent issues to deal with money, and we are very privileged to participate. The topic we are handling today of family and money is very key, and that's why on a Saturday morning, it's a good thing because I know many of us are at home and with our families. So we are hoping we are all tuned in as a family. That means parents, children, and whoever is living under our unit, because it's very critical that we move together as a unit when it comes to money matters in a family if we are to progress. Allow me to screen share.
Maybe while Alice is screen sharing, we could get in a bit of views from participants on call. We want to share your views regarding family and money. How are you dealing with the issues of family and money before Lucy shares with us her concept? Or Lucy, are you good to go now?
Yes, I'm good to go.
Thank you.
Yeah, money as a definition, I think we are all familiar with it. Basically, it's a medium of exchange that we use in transacting and making sure we meet our needs, and can be in banknotes or coins. Money is essential for better family relationships. That one, we can't run away from it. So it's critical for the parents to ensure that we get it, save it, invest it, and keep it, to have a better family life, which we all desire, because we need it in all spheres of managing family, right from planning a wedding, an introduction, preparing for child birth, raising. We are familiar with all that at every stage, money is critical. So to be able for us as parents to ensure we fulfill our role to nurture children and take care of ourselves as well as individuals and our family members, money is very critical. I felt it key to run through the realities often faced when it comes to dealing with money, especially between spouses, experiences of lack of trust, conflict of interest, communication problems, like Ronald had hinted it, which is a taboo to many to speak about. And once that area is not handled, openness when it comes to money issues, it creates really tension in families. For some, it has led to bigger issues. Distress is there, because if one party is handling money, especially in engaging into acquisition of debt, and at the end of the day, it has a big impact on the family if it's not well managed. We've had scenarios, even in our experiences, I'm sure, in our networks, where families have broken because of money challenges, where we failed to meet the basic needs to that level, where we've lost homes. Money is very key, that we need to learn about it. And from my experience, much as we've all gone to school, whether you have a PhD, we can all attest that in our curriculum, most of us have not learned anything to do with money. So we even start off immediately working when we are completely green on how to handle money, and we immediately engage and indulge into mistakes. So a number of us have lived lives of really, I would say, paying school fees to learn how to handle money with our hard-earned salary or income, if it's from business, and we've made mistakes. But the beauty is we have to keep learning, and mistakes is one way of learning, picking real lessons that we can build on to prepare for the next level, or to avert the damage that would have been much later. So the earlier we make these mistakes, the better. But in the state that we are in this generation right now, there's a lot of training, a lot of help. People have come out with experiences that have really pushed them to have such seminars, write books, do some coaching in the area of handling money. And it's key, and we'd be doing better ourselves if we really invest in education, in self-education, to learn how to handle money. And for those that are still young in employment, just starting their career, it's the best time, the area we do it, other than start picking lessons when we're about to retire. The ideal money handling approach that is practical, that I prepared, that we all need to try if we are to start off or improve the situation. Because I know a number of us, especially the SAE earners, we live on debt. Because of the plastic cards, those that have credit cards, we basically live, if you go to do your balance sheet, you find the liabilities are almost ×3, or you may not even have an asset. You're basically living on debt. And one wonders, and I think most of us also question ourselves when we are into debt, and you wonder whether you missed a lesson in school or you are absent, but the issue is, in most cases, we've not been taught. So how do we improve? How can we start off to rectify whatever may not be going well? The first and key critical thing is to live on cash. We start with baby steps. If you've been used to picking groceries from a neighboring shop on credit, you have even a book, you know, where you record and you promise to clear end of month, it's high time we start living within cash. So we start with baby steps, try 2 weeks. When you start developing that discipline, it helps you reduce on the current debt and even avoid indulging in more debt, and then start on the saving that Alice will handle. And one best thing is to help yourself is put those credit cards away from you. Have the ATM cards away from you. If it's really a temptation, don't move them with your wallet, and make sure you only buy what you can afford with the available cash. And once we start with those records, it will help us into the next step, which is to increase our spending awareness. We need to know where our money goes, and we have to write. It's not off head. Get a notebook, have an expense tracker. You can have it as an app or in Excel. Make it simple, the easiest way you can jot down. And our spending, when I'm talking about spending, a number of us tend to think that it's only what we call big expenditures, but we have to be true to ourselves and note every detail, whether it's some 1,000 you've bought binyewa, you know, G-nuts, a little bite, or you've given 500 shillings to someone on the street as you pass by who is needy. Record every expense. Some of us are addicted to things like coffee, even if it is as little as a stick of a cigarette. Record. We need to track where our money is going. This helps us as we move ahead to identify needs from wants. A number of us spend money on desires, not things that we need. And in the end, when we add on even credit cards where we are paying percentages in interest form, we end up, you know, building debt. And we find whatever we have from head to toe inside the house is all on credit, which is not a desirable situation. And then we have to track, after we've tracked our spending, create a spending plan. The records help us to understand our habits, our trends, and then we start saving. Meanwhile, we are trying to live within the available income, the available cash, and not spending it all, being able to save some of it. Once we start with these baby steps, then we are able to achieve the desired saving positions, which will be discussed further by my colleague. We need to understand our spending plan, and then we find a replacement for one large expense in our monthly budgets for the family. We could have an example, because it's individuals who form families. So you start with yourself before even you can look at your partner's expenditure or expenditure on children. We have to start with ourselves. sorting our own self, and then we add on as members of the unit and be able to achieve the goal as a family. One large expense, I would take an example, a number of us love coffee, and you find we've gone into a habit. Every morning we are passing by a coffee shop, yet we could actually buy this coffee, buy that mug, and be able to prepare this coffee from home. So we all need to study our biggest expenditures, and then we start with one large. After you've succeeded replacing it, then you go to the next. So we start with the biggest expenses and we go handling each in their order of size. Another example could be lunch. You know, we spend on food. So you can pack food from home, have a lunch box, because I know most of us even prepare more than is enough at supper. Pack, and then you can warm it and have it. In that, you're able to save enough percentage that will help us revert the issue of expenditure. We need to identify these expenses so that we can reduce them. Ideally, a number of us are stuck into the expense right, that we even spend what we don't have, and that's how we accumulate unnecessary debt, and that is something not healthy for the family. If we have to have a better family life, we have to create a plan as well to pay off our debts, because that's what eats up family, that's what brings wrangles, that's what brings us to really undesirable retirement times, where some are short-lived. As soon as we enter into retirement, we don't spend many years because of the kind of financial crisis that we've retired to. We need to be not shy from seeking help. The other approach is we really need to seek help to manage our debt and also the family budgets. If we are honest that we are having a gap, it's very key. There are many firms, there are many consultants, there are friends who have worked at it, whom we may even know in our circles. The key is we shouldn't be shy, we shouldn't be closed up and suffer with the challenge, yet there are many people who are already gone through it and have overcome it, and we can seek help. Then we need to educate ourselves. Money, a number of us in families especially, when you say you're working, head of the family is working, immediately we all think we know the whole norm of, creating multiple sources of income. You just think, if I go into such a business, I set it up for my wife, things should work out. Meanwhile, you've not invested in education, in teaching yourself and the family members how to deal with money. Before we know it, the businesses are already collapsing. You put in capital, you never see it out. Instead, it's debt accumulating. That is brought about by risking in areas where we've not educated ourselves. So money is a discipline that has its own principles that we must endeavor to learn. And put your PhDs, put your masters aside, put whatever qualifications. When it is money, it also has its own principles that we all must endeavor to learn. And we must have, of course, mentorship. As I conclude, we all wish for a better family life, and money can present us a better life, but we need to embrace the principles. As I had said, there are tips on savings, how we can start or improve the level where we are at. There are tips on how we can best reduce debt, which we will dig deep into as the discussion goes through. Thank you very much. Over to you, Ronald.
Thank you so much, Lucy, for that very wonderful introduction. Indeed, you've mentioned quite a number of very important issues here, and I wish that everyone could really take note. You've mentioned that money is a discipline with its own principles. How I wish all of us could actually take cognizance, because this is something we really, many of us never seem to appreciate. Money can present us with better lives. Indeed, your money can. Sente yo esobola. Now, I want to invite our next panelist. I've already introduced our next panelist, and this is going to be none other than Alice Matama Mutabazi. She's savings manager at Hugford Microfinance. Alice, you are most welcome. Hello, Alice.
Thank you, Ronald.
You're welcome, Alice.
Thank you, Ronald, and thank you, Lucy, for the presentation. I also want to thank the Uganda Institute of Banking for giving us an opportunity to share ideas and knowledge, as well as to learn new insights from the different participants. Let me share my presentation.
Okay, in the meantime, while Alice shares the presentation, let me hear from the team in the audience. What are your key takeaways from Lucy's presentation? I've talked about the key issues that have stood out for me, money being a discipline and how money presents us with opportunities. Alice, are you good to go now? Okay, thank you, Alice. I'll leave it to you now.
Thank you, Ronald. I'll straight away go to our main discussion, which is savings management and family and money. I will not go into the definitions because my colleague has already done that. But what is very key for us is to understand that talking about money is very key to family dynamics, and it usually centers on where will the money come from, as well as where will the money go. In most cases, as a family, those are the main questions that we have. Where will the money come from? And at the end of the day, we need to know where did the money go. So I've come up with a list of different sources of income that families look out at. We have salaries, wages, investments, and trusts. Those are some of the sources of income to families. And we have the other arm where the money goes. Those are utilities, mortgages, school fees, and medical expenses.
Hello, Alice. Okay, in the meantime, while we wait for Alice to reconnect, Alice, are you connecting? Okay. while we wait for Alice to reconnect, I've been getting some feedback here. Winnie Nasite says that what stood out for her from Alice's presentation is what stood out for me, the importance of tracking expenditure on a daily. You know, there are times you have a lot of money and then it just disappears. The blue living, you know, it just disappears out of the blue, leaving you wondering, you know, where in the world it went. That's, you know, feedback from Winnie about, you know, the lessons that she took from Lucy's presentation. Godfrey Odama Ezati, the key takeaway from Lucy is, hello, is Alice trying to reconnect? Okay, Godfrey says, the key takeaway is that, you know, baby steps of trying to live on cash for at least 2 weeks so far, you know, as far as COVID is concerned. So these are some of the key, I mean, this is some of the feedback which is coming in from the audience. I see we've got quite a number of people here. Please don't be shy to type in, just let's engage, talk to us, and let's see what lessons you are taking away from this. This is a dialogue. We know that many of the things that we are, you know, getting from the panelists are things that we live with in our daily lives. So let's engage, let's share, let's get talking. What's that which stood out for you? How do you manage your own money in your own life? Please. Is someone typing? Winnie still says, I'm glad to be a part of this. So probably the information that Lucy has shared has really been informative, and it has touched her to say, okay, I think it's worth my time being on this call. What do other people have to say? Please, let's share what your ideas or views about money and family are while we wait for Alice to come on call again. You could also raise your hand and talk to us. What do you think is this issue about money and the family? How do you go about money and family in your own life? It's not a new thing. We all earn money one way or the other. Even those who don't have a salary, at least there is a transfer payment coming in. So how do you go about money, please? Lucy, do you want to come in on something? Okay.
Yes, thank you. As we wait for Alice,
Yes.
I could give the tips in the meantime.
Yes.
To deal with debt. Alice is handling saving, but when most of us are living in debt, it even gets more complicated to think about saving. You know, yes, I have to do it. And the number of SAI earners with an exclusion of the mandatory savings that our employers enroll us into, you find there's hardly any saving on the side. So we need to first deal with what is eating up our money quickly. And some of the other tips, after you've managed to record and you've come up with a budget, it's very key. Even the shopping, for example, that we do at home. A number of us do it off head. And when we have excess cash, one of the tips is to move with less cash so that you stick within what you've carried in your wallet. And this affects mostly us ladies, and we are the home managers, but our spending is in most cases spontaneous. You see something which you didn't have on the plan and you chip it in. So we need to have a budget for the shoppings that we do at home and stick to it. Now, from my experience, what we do, I've involved even the children from drawing the weekly budget, because that's how we start as a family, trying to plant the critical approaches, the baby steps, so that we start grooming even the children early enough. A number of us have fell short because we were not exposed to those good habits early in our age. and we have to learn them a hard way in our advanced stage. So you have to have a groceries list shopping, a weekly. Now what we've done, we've separated duties to involve everyone. The children initiate together with the house manager. I review, have it into an Excel sheet, and then forward it to my husband for approval, and then releases the funding. So we have to adjust. In that, we are trying to make sure we reduce the debt. So there are certain things we shop impulsively, but right now we are in check because of those shopping lists, and we stick to them. So you can do it manually. You can have an Excel. The simplest way, don't make life very difficult. We can purpose to pay more than the minimum on our debts. If say your loan is 50%, for example, most of us work within those salary loans, you can purpose to pay more than the 50%, because the faster you clear your debt, the better, because you'll be able to save that interest accrued from very prolonged debts. Spend less than you plan to spend. So even with after you've made the shopping, try to negotiate, try to go for discounts, target the promotional times, and be able to take care and advantage of such discounts. And in trying to also save, we have to look out for such times when there are sales pros, and then make sure you buy those that are not perishable. You stock them so that they can push you for some time and skip some monthly shoppings. In that way, you'll be trying to save. And then in the approach of reducing debt, start with the most expensive debt. So we need to have a good record and tracking of our debts. And then we start with the most expensive, handle it, go to the next, so that we try to save as much as we can. When it comes to family, for example, a number of us end up having like 2-3 cars in the compound. If we are really pushing for being financially independent and being in charge, living out of debt, consider having one household vehicle. Consider, walking to work. A number of us live quite far from our homes. Yes, we know it, it's a norm. Probably you're living in your own house, but we need to sit down when we have those expenses and map out, is it worth moving this distance? If you look at the transport costs involved, the schools of the children not being near, you can make a choice to come closer. You rent out that house, the one of your own, use that rent to secure a near home towards your workplace and schools, so that you reduce on that transport cost. There are certain things, sometimes if we don't dig deep and analyze them, that deplete our hard-earned cash or income and end up actually accumulating debt. So we need to assess as a family all those when we are making decisions to get out of debt and get a better, healthy financial status as a family.
Alice, Lucy.
Yes.
Hello, Lucy.
Yes, please.
Yes, thank you very much for that extra insight. I see Alice has reconnected.
Okay.
Do you think we could?
Yes, let her continue.
Please. Yes.
Yeah.
Alice, if you are ready, please come on call. Alice?
Yes, Ronald.
Yes, we are ready for you.
Okay,
You're welcome. Please.
All right. Sorry about the inconvenience. I had issues with my network, but now I'm ready to go.
Apologies long accepted.
Thank you.
Yeah.
So our key discussion is going to focus on answering two questions. Why is it important for families to manage their finances? That is very key. And then we're also going to focus on how do we manage our family finances. So we need to answer two questions. Why is it important, as well as how do we do it? So before we manage our finances as family, we need to understand the importance, why it's important for us to manage the finances. Number one is when families manage their finances well, they're able to meet their household needs. Like my colleague has highlighted, we have different needs as a family, and some of these include medical, school fees, utilities, as well as mortgages. So if we understand the reason as to why we need to manage our finances well, then we shall be able to
Yes, Alice, are we having another connection problem? Alice?
Yes, please.
Are we having another? Okay, yeah, we can hear you now, loud and clear.
Perfect. So
yeah, I thought we were losing you again.
No. So like I said, we need to understand, once we understand the importance of managing our finances, families are able to meet their household needs. They are able to plan for their future. They're also able to meet the family emergencies as well as pay their obligations, which include taxes, debt. And at the same time, families are able to help or support other non-family members as well. So what is key for us to understand is how do we manage family finances? As a family, for us to be successful in managing our finances, we need to set goals. And these goals, we must keep them at front. So as a family, we all know that we have short-term goals, we have long-term goals, as well as intermediary goals. And these depend on our cash flows. So for us to be able to successfully achieve our goals, we need to be able to highlight what we need to do in the short term, long term, and medium term. So long-term goals, these are dreams for the future. And usually they are set for more than 5 years. And these examples include retirement funds, paying off mortgages, and saving school fees or tuition for our kids. So as a family, in order for us to manage our finances well, we should be able to see afar and plan for the future. Then we also have intermediate goals. These are usually objectives that are attained within a period of 1 to 5 years. And the examples include having a home for the family, buying a car, or paying off a debt. Then we also have short-term goals that we need to achieve as a family. And these include creating an emergency fund, saving for personal goods or for a trip, and payment of school fees. Another reason why we need to manage finances for our families. Rather, another way how we can manage family finances is having a spending plan. A spending plan is what we can call a budget. We need to know how much we are going to spend and on what. This will enable us to prioritize as a family so that we don't leave out the basics in life. We've had experiences whereby if we don't have a spending plan, we end up spending on things that are less important compared to the basic needs. So once a family comes up with a spending plan, they are able to prioritize things that are going to be achieved first and which are important to the family. The other way of managing family finances is having a savings plan. A family should always have a savings plan, which is a strategic process which allows them to make measurable, sustainable, and consistent progress towards achieving their goals. So once we come up with a plan on how to, because a savings plan enables us to achieve our goals that we put in place. So when we have a savings plan in place, we are able to know how much money we are going to save for our short-term goals, for our medium-term goals, or our long-term goals. And this will enable us to cut expenses and prioritize on saving. It is very key for each family to save, and when it comes to saving, everyone should participate, right from the kids to the parents as well. Another way on how a family can manage family finances is by having an investment plan. We've discussed that we need to have a savings plan, and once these savings accumulate, it is important for a family to come up with a plan on how they are going to invest this money so that it keeps making more money for them. And as a family, we believe you can invest in different instruments. If it is cash, you can choose to place it in deposits, treasury bills, or bonds. However, we can also invest it in real estate so that the money keeps growing and you protect it from inflation. My next slide is on how to raise kids that are smart in money. As a family, when it gets to money matters, it's not only the parents that are involved. It is very important for us to raise kids that are money smart. And how do we do this? As parents, we need to start teaching our kids to appreciate the value of money and how to protect the money, as well as how to save it. We can achieve this by involving the kids in family finances. And how do we involve kids in family finances? We can choose to teach them on how to lower utilities. For example, they shouldn't leave the water flowing. They shouldn't leave on the TV while they're not watching. We need to also teach them how to cut expenses or to cut spending. For example, if it costs you like 500,000 to celebrate a birthday in a restaurant, you can choose to convince your child and you celebrate the birthday at home and spend less than what you would have spent in a restaurant. So while we are making such decisions, we are teaching our children or kids to be smart in managing finances. So we also need to teach our kids to save. Saving is very key, and because it is a culture, it is something that we need to start as soon as we can. So for the kids, it is the best thing you can give to them. Teach them how to save. And this is something that can be achieved in a long term. We can also raise smart kids if we engage them in setting up goals. So as a family, when we come together, as we plan to buy a new home, we plan to take our kids to university, we should engage them so that they appreciate that some of these things we can't get them in the short term, but if we focus on them, if we plan for them, they are achievable. And once you introduce to them the idea of saving, they will appreciate that the reason as to why they're doing this is because they want to achieve a particular goal. So as we set goals as a family, we need to involve everyone, including the kids. I also encourage us to teach our kids to save, but also give to charity. I believe if we teach our kids to give, that will also make them better citizens in the future. Then next, at UGAFORD, we have different products that can enable a family to achieve their targets. For example, a target account. If a family has a target of purchasing land or building a house, they are able to open an account, which is a target account, and deposit money for their future. It's a flexible account, no charges, and no monthly charges. We also have a junior account, which has specifically been designed to encourage children or kids to grow their savings. So if you introduce your kid to such an account, they are able to save for their future, knowing that they can achieve their plans. Then we have a fixed deposit account, which a family can use to invest their savings, and this goes as low as 100,000 and above, and you can earn an interest of up to 12%. That is the end of my discussion. Thank you.
Sorry, I forgotten to unmute. Alice, thank you for the presentation. You actually brought out something which tickled my mind. You know, we've always been talking about issues of teaching children how to be involved in money. And it had actually never occurred to me that teaching children on managing utilities in the house, for example, not wasting water, not wasting electricity, lighting rooms where no one is actually doing anything, and leaving the TV on. You know, these things have actually never occurred to me as a means of, you know, engaging children in financial management of the home. But you did raise key issues here, and I really appreciate that you brought in things which we can actually get our children to do, or to involve them in financial well-being of the family without actually spending money. Convincing them not to go to a restaurant and instead have their birthday home rather than, you know, and save that money that would have been spent. And also, this is a notion that I've always had, people talking about never missing an opportunity to sell. You must be a very good salesperson, really, when at least you took the opportunity to highlight to us the different products that UGAFORD offers. The fixed deposit account is that product that we've been always looking out for, but many organizations within the industry have their rates fixed so high and out of reach. But at least you've actually mentioned, and I know that many people within the audience have actually taken note that UGAFORD has a much cheaper fixed service or product that we can take advantage of. Thank you so much, Alice. And I also want to inform the audience that we're going to have a simple poll, which is going to run in about 1 or 2 minutes. We want to know your culture. We want to know how you go around money within the house. It will be coming on your screen soon, and when you see it, please just complete it and submit instantly. On top of the poll, yes, the screens, you should be seeing that poll coming on your screens just right now. Now, having said that, we want to encourage families to engage in financial literacy trainings, and for that matter, any families and couples who are online or who are on call will be awarded with a book by Moses Mukisa. The title is Straightforward Financial Growth. It's a very good book about on financial literacy. I've read it, and if you are there, you are tuned in with family members, children, or wife, please let us know, and we will be sending you a copy, or you could come through to our office at 10 Buganda Road and collect yourself a copy of this book, Straightforward Financial Growth. We will be giving out books to 5 lucky winners. We only have 5 copies for today, and we want only 5 people. Please talk to me via chat, and let's see how this can be worked out. The poll is live. Please, this should take us about maybe a minute or 2. Just say yes or no and submit. Is everyone seeing the poll on their screens? If you can't see it, please say so in chat so we can see how we can send it over. While we also deal with the poll, like if you happen to have finished, please still don't hesitate to talk to us about your key learnings from Alice's presentation. I see quite a number of people writing in to say they are happy to be with us on call. That's very good. But then it's, yes, much as we love you to be happy, we also want to know that you are taking lessons for the betterment of your own financial health. Please chat to us your key learnings from the presentations, such that we can know that we are actually having impact, and we are driving towards that positive behavior change that we are driving at. The poll is on your screens, and we should be submitting now. If you are done filling the poll, please submit, and we could see what we can proceed. Okay, we are done with the poll. I want to go through some of the feedback that has come through here. Alex says money is the backbone in every family, and that's much agreed. Both Alice and Lucy have said it. Families can, money can strain relationships, and this is very clear. You've seen when on the offset of COVID, many families broke up. There was a lot of increase in domestic violence, and most of these cases were reported basically due to the poor financial well-being that families found themselves in during the lockdown times. So really, Alex Akankunda, that's much agreed. I plan on how to spend, but then many unforeseen things come through. That is a comment from Jennifer Baluka. Good morning, friends. First things, you have to avoid debt, probably that Alice has talked about, and I know that we are all taking notice. One common thread which is ringing from every webinar that we have had is that of having a savings plan. Really, if it is something that we all must take from the series of webinars that we're having, speaker after speaker, panelist after panelist have indicated that it's key and very, very important that we have we get intentional about our financial management or our personal finances, and developing a savings plan has been a recurring thread. I will now, in about a minute, be sharing the results of the poll that we've just had. And these are our results. Do you believe it's a good idea to discuss money with family? All 100 and we've had 106% respondents saying that they agree. All participants on call agree that it's a good idea to have discussions with the, to have money discussions with the family. No person said it's not a good thing. So probably all of us actually agree. Do you ever talk to your children about money? 83% of the people said they do. And we have another 23% saying they never talk to their children about money. How often do you track your spending? Once in a while, 31%. 31% of respondents only, only 31% track their spending pattern. 57% said they sometimes do track their spending, while 17% report to say they never ever track their spending pattern. So that's what those are the results from our poll. And I know that it's good to know that at least quite a big number of people within the audience, myself included, believe that it's important that we engage family members about money and that it's a good idea to keep track of our savings. Okay, now I want to open up the question and answer session, and there have been quite a number of questions that are coming in from the audience. There's one which is really interesting, and I would have loved to look at the face of the person who shot this question. This is Joshua, and he says, how can someone manage saving and budgeting on an irregular income, and in brackets, suffering on commissions as agents and/or sales persons? I do feel your pain, Joshua, because once, in my career, I did have a job as a salesperson, and I know how frustrating it can be to earn commissions. We're going to get answers to this question from our panelists. Okay, that is Joshua. I'm going to be. I'll set in 3 questions, and between Alice and Lucy, we can know who is going to be helping us with what. But probably we could share, because this is a dialoguing call. We could always have input from each and every one of the participants. Then Bonnie LB is asking to say, please explain how clearing off a loan with a bank works in case I get the remaining amount on the loan before its time elapses. Is it beneficial? Like, how do I benefit from clearing a loan with a financial institution before the time actually of the loan is expired? Number 3, and the last one for this first session, what percentage of my income should I consider as saving in my budget? Or what do you actually recommend? That's Janet Nabitula asking. Our panelists, kindly help us to share your experience regarding the questions that have come.
Can I start, Ronald?
It's okay, Lucy, you can go.
Okay. Thank you very much for the active participation from our participants. I will speak to the questions, starting with Joshua, I think, who is thinking and wondering how he can have a steady saving plan when he's earning commissions, which is also irregular. When it comes to principles of saving, we believe even a child can save, and there's no other person, I think, in the hierarchy that is with unclear money sources as a child. But the key element is when you have chance to earn, to hold some cash, don't spend it all. So we have to plan and live within whatever we call little, whether it's 20,000, whether it's 100, whether you're getting 10. The issue is when you get that money, make sure you save aside. When it is still meager, of course, we can use percentages. You can start from 10%. Make sure if you get 10,000, put aside 1,000. But ideally, as recommended, the more you save, the better. If you can push it to 50%, if you can push it to 60, it is better for you as an individual and better for the family. But we have to set realistic targets, like Ali says, when you have a saving plan and a goal. To be successful at saving, we must have an achievable goal. So you start small, so that when you achieve that small goal, it gives you motivation. Every one of us needs to be, successful at whatever we are planning to do. So if you set yourself an achievable goal to start with, then it will give you energy to graduate or to stretch yourself further. So we can start with the basic principle of 10%, like how we do tithing. When you get your money, you must tithe 10%, have the other 10% for saving, but ideally saving. And we can also start as low as 5%. Our employers have helped us to at least start somewhere. Save that 5 if you feel the income is still less, but don't stick to 5, don't stick to 10. As you work on your spending plan, as you reduce your expenses, the whole goal is to ensure you're increasing the other side of saving. Then the one who asked about the benefit of clearing a loan earlier, yes, it is, because every time you keep somebody's money or an institution's money, you're paying interest. So there's accrued interest. So if you pay it off earlier, you're saving the interest. An example is, say you had taken a facility for probably 3 years or 5 years, and then you can pay it within 1.5 or 2 years. Certainly the interest you would have paid for the other 3 years ahead, you've saved it. Certainly in banking, there's usually a penalty for early closure, but it's not equivalent to the interest that you would have paid if you retained the loan. So that interest that you've saved is basically the saving we are talking about. And we shouldn't be saving to spend or reduce, and then so that you have enough free cash flow to spend. No, our goal is to ensure whatever we can add on the plate is thrown into our saving box to enable us invest for the future. What percentage of my income should I consider? I think I've hinted on it. If you can stretch yourself, especially I always speak to the young, if you've just joined in working, it is the best time to start saving. And remember, when you're joining, of course, you're still earning less, but your expense plan or your spending plan is still equally small. If you're not yet married, you certainly don't have, family to spend on. The children are not there, that the fees budgets are coming in, medical and the like. So push yourself. Actually, when you're still single, you can push yourself to save 80%, even 90%, it's possible. A number of us on this can testify that most of what probably we have accumulated or built on was mostly done in our early years of our career. But as you grow, as you add on responsibilities, children are coming on board, parents are aging, the families are expanding, you end up almost spending whatever you earn. So the earlier we can start saving, that means we push ourselves to spend less and save more. So the percentage is really not fixed. It depends on the circumstances that you're in, but ranges from 5 to 80%. Yeah, that's what I can comment.
Thank you so much. Thank you so much, Lucy. I think the participants on call have taken note. Probably everything has been exhausted. You've heard Lucy, I don't need to repeat her statement. Now, Lucy, I've got some more questions coming in. But before we go to Lucy, is Alice still on call?
Yes, Ronald.
Okay.
Yes, Ronald. And
okay.
I would like maybe
yes.
to add on
Please.
what Lucy said.
Please go ahead.
About the first question that Joshua asked. When it comes to earning, there are things that are not compromised, like the taxes. You have to pay your area tax.
Alice, do you want to open your camera so the audience can see you, please? Okay, thank you.
So when it gets to earning, there are things that are not compromised. Like, for example, taxes. There is money that has to be remitted to URA, and we have, for Christians, you have a tithe that you give out. So if you want to achieve your saving objective, then you should prioritize saving as well. You must include it as a priority on your list. As soon as you earn your money, chop off your 20% as a fixed amount that has to be taken off, like the way taxes are done.
Okay, is that all, Alice? Yeah, the statement is very clear. Savings should be equated to tax. When you get your money, take that 20% and keep it in wherever you can't find it. You know? Okay, now before we proceed to the next set of questions, I also want to read out the comments and feedback from different panel from our audience. We've got Galaxy Prime. My take home is to reduce debt starting with the most expensive. Thanks, thanks Lucy. Godfrey Odama Ezati, we've just agreed as a family, right now to start planning and involving my kids in the planning as well. Wonderful. You know, at least we know that there is impact right there. That's immediate impact. We really hope that you could push through to make sure that this becomes a part of family culture, not just excitement. It happens in many motivational speeches. It's a great presentation. My learning is that for families to be financially successful, we must purpose to manage expenses. In other words, it's purposeful spending or probably having a clear savings plan. That's Barbara Kayaga. She also goes, oh, so this is Baz Bazala. If the children are not taught about money early, one will have very spoiled adults who can't keep family wealth. And that is very true. That's why at a certain point, the Forbes magazine reported that many multi-billion families have not been able to keep their generational wealth as, you know, successive generations keep succeeding. So probably this is where this is coming from. We need to keep teaching our people money management skills. Richard Chione, the main problem we are facing is saving after spending. Saving after spending. We need to learn saving before spending. This is a very contentious issue, and many financial literacy experts and the financial wellness advisors tell us you should spend before, you should save before you spend. But it's a lesson which, as an individual, this is my personal experience. It really took me time to come to terms with this statement, because I first engaged with this idea when I read Thomas Kiyosaki's book, Rich Dad, Poor Dad. That was about my A-level vacation, but I never actually got to understand this topic until after I graduated. And it took me another couple of years to actually start implementing it. That was after joining graduate school of business. So I really wish that between Alice and Lucy, you could try to shed some light in very simple English, low, that even a lay person could understand. The concept of saving before spending, it's becoming a common phrase, but then again, implementation, there's an issue around implementation. Please, Lucy, do you want to react to that before we proceed?
Yes, thank you very much, Rona. Saving has to be, we have to find forceful means, that is for sure, because when money is there, I tell you, spending it is the simplest, one can do. Even if they gave you $1 billion today, you can ably spend it. Why? Because we have the part of us of wants, those desires, the wishes, where we want to be, they always involve money. So there's none of us can say that has enough to first spend and then spare something for saving. That is almost close to impossible. That's why it has to be mandatory. And we must make sure we save the most if you really want to be financially independent and have a really better family life. That's why we are saying, like Alice, have a percentage without negotiation. If you fixed as a family, you've agreed, for example, if both wife and husband are working, you can even push it to 40, 50, so that each of us puts a 20 or 25, and then we knock it off before, as soon as the salary comes, the saving must go off, because already the tax is already held by the employer. So the only bit we have in our control is to knock off the saving and knock off the tithes. When it comes actually to percentages, the charity is there as well. In our African tradition, we know we live in extended families, so we have responsibilities. So there are those mandatory expenses that you have to put in your budget and knock them off. Now that will help you save maybe like 30%, which you have to spend on these other weekly shoppings. So when you leave yourself with less, that means you can actually live within it. You adjust your budgets to live within the 30% on family expenses, the routine expenses. But you need to have even a percentage for investment as well. So saving is not easy because we don't have enough. That's why we must save first, have an ambitious target and knock off that money. And then when it comes to saving as well, for it to really be practical, have a goal. As a family, we can have a goal. When we have a goal, it pushes you. What makes it hard for us to save is, again, not having saving goals. Now, at a family level, I can take an example. If right now we are renting, and as a family, we sit, the children are also involved in this decision. So we set a goal as a family that probably in the next 3 or 5 years, we want to buy a plot and be in our own, probably 3-bedroomed house or 2-bedroomed house. We start small and keep graduating. Now, when we have that goal, we attach, it's not just a wishful thinking. If we are talking about a plot, we must be specific which area, and we are considering, of course, the income we have. Are we buying in Gayaza? Are we going to Magere? Be specific with the location. You should have surveyed the costs of plots in such areas. Have a target attached. Is it 30 million that you're looking to save, or 50 million towards this project? Now that is at buying probably 100 by 100 or 50 by 100. Now, you must also attach time. When do you want to be in this house? Now, that house also have BOQs as a family, have a budget, how much you're going to spend. So engage an engineer or your mason, have a budget. It doesn't have to be that technical, so that you have an idea of the amount you need to save for that project. So if you establish, say that you need 100 million in the next 5 years, then break it down to each year, how much you need to have accumulated, bring it down to monthly, bring it down to daily. Now that gives you an indication of how much you need to save. Now, when you have that exciting goal that every family member is aware, and we actually encourage that we have these goals put like on a board in a visible place for every member to look at every day. So it gives you motivation to wake up, go to work. If it is a tip you've got, make sure you save that extra income over and above your routine salary, save it towards this project. So the faster we reduce our expenses and put in this saving box for this project, the better. So when we have a goal, it makes it easier. With such a goal, why we say even when the children are aware, they will stop asking for, crying for ice cream. You go with them to church. There are those toys that are displayed. They want to buy unnecessary things which they will not even spend a whole day with. So when we have a goal, we keep reminding each other, if you're asking this, we say, we want to do this. The next year, I want to have a plot of our own. We want to move from a rented house to our own house. So it makes it easier. Yeah. So that's what I can jot in on that issue. So saving, we have to make it mandatory because we never have enough. Our spending is that way above.
Lucy, thank you. But before I let you go, and before I invite Alice to come in, you talk about time, and this is another thing which also gets me thinking. Yes. I was reading some report over the internet a couple of weeks ago, and this report was reporting to say increasingly many people all over the world, especially young people, identify themselves as non-Christians. They don't identify themselves with any kind of organized faith. Let me put it that way, because you don't have to be a Christian, So and from the statement of paying tithe, it appears that besides this tithe, 10% of whatever I earn does not belong to me, has to be given away. That's the interpretation here. Okay, now, for many people who identify themselves as non-Christians, myself included, that's why it tickled me, and I had to ask this. How do we go about the issue of 10%? I'm not giving it to church because I'm not belonging to that kind of arrangement, but then I've got the 10%. How do I go about this, Alice? Lucy?
Thank you very much. As I had hinted a bit earlier, we basically, when we come to life, why we are created, it's beyond ourselves as individuals. We are in this unit all for a specific purpose, and which none other than yourself can fulfill. So we need to really dig deep and identify. And we live for others, that is for sure. That's why, much as it may not be going to church, because in most cases we give it to church, because most churches have activities or programs that actually help the wider majority, the vulnerable team. It could be orphans, it could be, the elderly and the like. So when you belong to a certain organization, your contribution speaks to that. So by the end of the day, we are destined to support the other person who is less fortunate. So as a family, we can also have that percentage to do such activities within our neighborhood. For example, we shouldn't be close to the needs of others. So the main issue is, even when it comes to contribution, so you can have that percent set aside to help you have help or meaning, or bring meaning into somebody's life. The sick, the elderly, we have many people around us who really need support. So we can have that percentage towards that activity, and we'll certainly be contributing to,
Thank you, Lucy. That's a checkmate. Not belonging to organized religion doesn't mean that the 10% belongs to me or belongs to you, whoever. You know, charity still exists, and we need to donate to charity. Yeah. Now, giving or being generous is a common thread that has been recurring through all the webinars that we've had. Miranda talked about it. Joanne talked about it. Lucy is now talking about it, and Alice has mentioned it. So if we are to learn anything from this, besides our own wellness improvements, giving for charity is something that we cannot do without going forward as we become financially well and financially literate. Thank you so much, Alice. Now, I've got some couple of questions on the side. And this now speaks to Alice. Alice, are you with us? Alice? Alice? Okay, probably she's dropped off call, but we'll be engaging with her very soon. Okay, yeah, Alice is here. Alice, you with us, yeah?
Yes, please.
Okay, all right. Now this speaks to you. I want to, many of us within the audience would actually love to know, being open about money is something that we are being encouraged to do while we attend many of the financial wellness programs. But then there are always issues about openness. So if I'm going to open up, who do I open up to, and how much openness how much open should I be? That's number one. Then the other one, but I think that one you've already addressed it, the issue of dealing with children and making them financially literate. You've already spoken really well about that. So let's just go with the first one. How much openness is required within a relationship? Or even probably before I let you go, at what point do we start opening up to family members? Now, in my understanding, when we talk about family, it's me, my wife or my girlfriend, and our children. Okay, at what point do we start opening up about money? When we are dating, when we are engaged, when we are married, what are these steps? Alice, please.
Thank you, Ronald. Money is a difficult conversation when it gets to relationships and marriage, but I would recommend that at a level when you are husband and wife, you should be in position to open up 100%. Why? Because it is the only way you're going to live reality. We've seen cases whereby family members do not disclose their income levels. Others pretend that they are earning more and they live a fictitious life. Yet, the reality is that they do not have the money. So at that point, your spouse will start thinking big, dreaming big, and spending big, thinking that you have the money, yet you are living either on debt or you're living on advances. So it is very important at this point, if you are married, to open up. If you're earning less income, let your spouse know the exact amount you're earning, and then you come up with a plan. Because there is no way you are going to achieve your plans as a family. There is no way you're going to achieve your goals if you do not open up to each other. So I would advise that as a family, we should be able to know the incomes that we are earning and then be in position to plan and budget for what we have, and then see how much we can invest, see how much we can spend, as well as determine how much we are giving out to charity or to family members. So I strongly believe it is a good idea for family members to come out and share their finances as a team. That helps to solve many issues. And also it enables the family to move from one level to another.
Alice, thank you. At least we now know that when it comes to money, openness is key, and openness is openness. There is nothing like 20% openness, 50% openness. When you open, you must be open. That's openness. You know, there's no option when it comes to openness. Lucy, you seem like you have something you want to say about this issue of openness, being a Christian, really. Do you want to, what's your take here?
Yeah, I concur with Alice, and I wanted to comment on your question when you said at what point is it when you have a girlfriend or dating, you know. I actually think that it's a key area that we need to discuss, even as we call it the marriage counseling, when we are being prepared for marriage. It's a key area that has to be discussed. And actually, when you look at how the relationships go, for the side of to tell that you're heading to serious commitments, that is when you start discussing money. If you, as a gentleman, you're opening up to your girlfriend about, you know, the plans you have for the future, and it's dealing, you know, with money, that's already a sign that this person is serious with me. So, and I believe once we start opening up early, when we are still actually dating, most of us meet when we are at zero, and the little we have, we can open about it, plan for it. You know, you can be earning, and probably you're thinking about buying a plot jointly, because at some point, it's too hard when you're starting to buy a plot alone, but you see yourselves coming to those agreed decisions where you can pool, each saves maybe 100, and then you buy one plot together. You know, by the time you're getting serious, that same plot is probably which will be your beginning to build the house. So personally, I think money matters need to be discussed earlier, even when you're still dating. You start opening up, it makes it easier to flow into marriage because you've already set a system. Yeah.
I wish I could hear from what the rest of the audience thinks, because I remember when we were still students, either in high school or at university, this issue of, you know, you always wanted to be the big dog around. Even when you didn't have money, you find a means. That's when boys could eat school fees, because the moment you get blacklisted as that guy who is always broke, then you are into real big trouble. Thank you so much for the insights. Now, before I get to Lucy again, let me read out some of the comments that are coming in from our audience. Irene Veronica says that my key takeaway is the importance of tracking your expenditure, like Lucy put it. Even a cigarette bought or you know, some money given to the poor is still money. That should be tracked. That way, we are able to know where our money actually goes. That's Irene Veronica. Then Samuel Eyangu, it's a good practice to actually involve children in planning for family finances. They'll grow up with these kind of principles. Lastly, Goretti Masade says, great take, good lessons shared. Thank you from the audience, Irene, Samuel, and Veronica. Now, let me also turn to Lucy here. And this is something which is eating up much money from many families' budgets. And this is the issue of school fees. Actually, I remember when I was a small boy, many parents within the community where I lived now started competing on who is taking on who is taking their children to which school. You know, in order for you to prove your financial muscle within the community, you had to take your child to the best school. School fees, inflation. This is a very contentious issue today. I want to know from Lucy, what's your perspective on the trend of families seeking out the most expensive schools, even when we clearly know that many of these schools don't add that amount of value like they pretend to be? And Lucy, maybe, okay, that's number one. But then again, there's also the issue of wills and family inheritance. Many of these wills are, they are held in secret. They're never shared until the last person when someone has actually died. Many of them actually also get stolen. People never discuss wills openly in families. How do we go forward with the issue of family inheritance? Because we know there has to be transition at the end of the day. People will die. That's a must. Lucy, please, your take.
Thank you very much. I would say that that trend sometimes probably is because of not going by the principles. I'm sure with several trainings and exposures in how to get really financial independent, some of those decisions I'm sure will not surface in our families. As I earlier took you through the practical steps of how to really get hold of the money situation in our families, one of the steps was to identify that major expense on your spending budget, on your spending plan. And a number who have taken that route, we end up in very, very bad debt. And at the end of the day, because even of the kind of probably system we followed, the children are still home. They are still dependents even after graduating. So what is very key is to first have your plan, your budget. And remember, we're trying to live within our means. There are still very good schools, not that expensive, and where you can put a child and they are modeled and groomed and come out very important. Not necessarily, most of us actually are products of such schools, the equivalent of the UPE now, but we've turned out. So it's not about the status. Right now, we find most schools, why they are even the kind of first class expensive, the investment is majorly in structures, the ambience, not the quality of the material gotten in the classroom. So we need to know exactly what we want, but within our means. So it takes us back to the drawing board as a family. Let's have a budget. Let's have and live within. If we know that we don't want to go into further debt, we want to reduce debt, certainly we may have to make those decisions to move the children to affordable schools, but with quality. If we look at the performance in schools, it's not those that really are where we are paying exorbitant fees that are always top on the list. No, we have those that are really, I can give an example right from my experience as a child. I remember I was in a school that time. 360,000 was a big deal in our days. So because of, as a family, that time we had a challenge that came up that my dad got a kidney issue, and it had to affect really the planning, the job. We had to relocate for medication. That time we could not get medication here in Uganda. We needed to move. So a lot of adjustments had to be made. And I remember as a child, I took on, I realized if we maintain me in this school, my other siblings will not be able to continue with education. I was the firstborn. So I took a candid decision even when I was young. There was a school for sisters way outside, far from home, which was good. I believed in the formation of the religious sisters, and I went and got a place myself. It was even in the middle of the year through a friend, and I moved, and the fees was way below, but I made it out and still advanced later when the situation improved. So it doesn't mean that it's where you're paying a lot of money that you get quality out of a child. No, we need to live within our budgets, and if your incomes can afford, it's fine. The key issue is live within your income. Don't push beyond means to instead indulge in unnecessary debt that will impact on the future. Yeah.
Wow, Lucy, that's you know, a very strong one. You said most of the fees that we pay are just ambience, and that's very true. I think many people within the audience are taking note, and I would really love to see reactions about this, because I know many of us within the audience are actually victims of this school fees scam. What are your reactions here? Now, let me just get back to the financial growth, the straightforward financial growth book that I had actually promised. I initially thought I would give this out for free just because people tuned in. But I think I want to change my mind a bit here, because it's a dialogue, but then again, there are lessons that have to be taken away. There is action that has to be implemented out of these lessons that we are having. Now, I want to challenge participants within the audience. We've got a Twitter handle. Please engage with us at hashtag YourMoneyCan. Go to Twitter if you got a Twitter account. Share with us your experiences from the webinars that we are attending. It could be this specific webinar. Please go there, share with us, engage with us, tell everyone about what your lessons, your key takeaways have been from this webinar, specifically this for families. We also have a portal, and I will, in about 10 or 5 minutes, I'll be inviting my colleague Benedict to speak about a portal where we have a whole range of resources where you could engage and learn more about financial literacy, you know, improve your financial wellness and get yourself to that financial health that you have always desired. The book is going to go to the first 5 people who will engage with us on Twitter and tell us their and share with us the lessons that they have taken from this webinar. Because at the end of the day, we are aiming at behavior change, not just having people on call, you know, chatting with us, and then when we are out of call, we just get off and resume to our, usual financial lifestyles. We still have a couple of minutes, and there is a question which is coming in here from Ongom David, and this is speaking to Lucy, if you could help us here. Sorry, Alice, if you can help us here. Ongom David says, what recommendations can be put in place to reduce on existing multiple, the keyword here is multiple loans. How can I overcome multiple loans? Alice, please.
Thank you, Ronald. In my own opinion, I would recommend first, before you borrow, you need to understand, do I need this money? Because that is the reason why you get into multiple borrowing. We need to understand and we need to prioritize when we are borrowing. So, and sometimes we borrow because there's someone selling some cheap piece of land, or there is a car that is on sale. You find yourself accessing a loan, and yet that is not a priority at that time. So before we get into borrowing, we need to understand whether it is necessary for us to go into getting that money, or whether it is a priority. So that will help us not to get into multiple borrowings. Again, we also need to live within our means, like Lucy said, because sometimes we set our bars too high, yet we cannot afford that standard. So at the end, you find that if you've taken, for example, you've taken your kid to a school that pays a lot of school fees, and you're unable to meet the school dues in time, you will find yourself getting into a situation whereby you have to go to a money lender to give you money. You find yourself getting an advance, borrowing from a friend or family member. And at that point, you find yourself entangled into debts. So we need to be careful before we make decisions to borrow. And we need to prioritize as well, so that we do not take on things that are not really a priority or are not important at that point in time.
Lucy?
Yes, please.
Sorry, Alice,
Yes, please.
you are done here?
Sure.
Okay, thank you for the enlightenment about multiple loans. This is something which is eating up so many people, and it's actually stressing. I know for sure debt can be really such a bad thing. I've never suffered one, but from experience with friends who are indebted, it's not a good thing. Now, there's something which is clicking in my mind. When we talk about financial wellness or financial literacy, we tend to think that each time we engage with these kind of debates, financial literacy is about growing your asset base and your bank accounts all the time. But then again, I want to have a second opinion here. You are the experts, and I want to get your view on this. The instances where we just have to be stable, we just seek stability. Because take for instance, me and my girlfriend, Fifi, are both working. Then at a certain point, Fifi is expecting and she can no longer go to work, or she's raising children. You see? And now we have been earning 2 salaries, but now we've got to adjust to a single salary. How do we go about that adjustment, really? Please, yes, Lucy, you coming in here?
It's well. Thank you very much. Yeah. Basically, the process towards financial well-being varies from couple to couple, individual to individual. It depends on where you are. As of now, say if we are starting today, the journey, you might find when you're in that scenario that you're in, you're starting, your starters switching from maybe both earning to a single earning. Certainly all those have to speak to the adjustments in the budgets that we are living in. So there are certain practical decisions that have to be made here. If, say, you've been living in a rented place, say where you're paying 600,000, so you need to come to terms to it. That means we would need to look for a cheaper place, and they are actually there. So you may have to shift location, scale it down, say to 300,000, because you must now flex your spending plan to fit in your single salary as the main breadwinner, without actually forgetting the other first principles of the savings. The savings also must come off that single salary, because as you're growing the family, you need to save for the future. These children that you're bringing on board, there are cases of medical, they are going to get of age to go to school. So you still need to save for that activity, and also have some for future investments. Say you have to have a plan of moving from rent to maybe buying your own plot. So when the income goes down, the rule is the expenditure must even go further down, because the principle of saving must not be violated or compromised because the income has gone down. So we check our groceries, we have to knock off some, expense lines, start taking on those instead of buying lunch, carry home, If you have a garden, some plot that you can utilize, there are certain things you can grow at home, vegetables, instead of having to rely on the market and the supermarket all the time. You have to adjust even your menu, You're getting all the nutrients, but within, affordable, foods. So there's a lot that you have to go knocking off to fit within that. Now, that speaks into also that question that Alice was handling of multiple borrowing. What takes us there is not having a budget. It's just spending, not having goals, and worse still, we borrow to pay off other loans. So you find you're trapped into a chain of debt, borrowing here to clear here, borrow here, at some point to the equation will fail to balance. So the first step is to really sit down and make a candid decision not to borrow, because borrowing to clear another debt is a short fix. It's a short term, but a long-lasting solution to sort our debt crisis takes time. So we don't expect it to happen overnight. That's why you have to go step by step. The first area to knock off seriously is the expenditure. You have to reduce your spending line so that you can save more to clear the debt, starting with the most expensive debt. And then, of course, you can have a plan with the creditors, to be open about your situation. When you're open, then they will adjust some knockoff or stop accruing interest, as long as you have a plan of depositing on each of those lines, but prioritizing the most expensive debt and being open about it. In most cases, most of us are shy about it. We suffer with debt. We are not opening up about it. We are not seeking help until it just drains, because there's a very direct link between the mental health with our financial status in the home, in the family. Because the moment that area of our finances is overboard, the debt is just skyrocketing, it's hard to really have depression sets in, anxiety sets in, strife sets in, and some people actually end up losing life if not well managed. Yeah, so that's why we have to really look to our expenses, expense lines, make those adjustments, change the renting, move children to affordable schools, adjust your menu, make sure you live within your means. Yeah.
Thank you so much, Lucy and Alice. I think the key takeaway for all of us on call is that there's no easy route to effective personal financial management. There's no easy route to family and finance, and that it takes really hard decisions when it comes to money issues within the home. There are no shortcuts around that. Thank you so much, really, our panelists, and for everyone on call. We really appreciate that you have given us time and to engage with us. Special thank you to Lucy and Alice for taking off time very early in the morning and preparing to be on call and giving us such wonderful knowledge and sharing with the audience and myself, your such rich wealth of knowledge. We really appreciate, and we shall forever be grateful. Going back still to the book that we have to give out, please engage with us on Twitter. Our Twitter handle is at #YourMoneyCan. We also have a web portal, and this portal is www.yourmoneycan.or.ug. In case you don't have a Twitter account, please engage with us on our portal and tell us exactly what you have learned. And once again, thank you so much, Lucy. Thank you so much, Alice. You've given us such a wonderful, insight into what money and the family actually means. You've just made a weekend, and I hope everyone has enjoyed. For everyone listening in the audience, please engage with us. Go to our Twitter handle, YourMoneyCan, or you could engage with us on the portal, just like Ben has stated. Our portal is www.yourmoneycan.or.ug. We love to hear from you. And the first 5 people to engage with us will win themselves a copy of Moses Mukisa's Straightforward Financial Growth. I want to thank you. I want to thank each and every one of you, and to our sponsors, our strategic partners, and platinum sponsor, Bank of Africa, Uganda. I want to wish you a very good weekend. Enjoy.
Thank you.
Your dreams only when you save every time you earn. Learn how to keep part of your income to help you, your family and business manage through emergencies like COVID-19 at the Banking and Financial Services Awareness Month. Meet the financial experts. Learn how to deal with financial hardships like those caused by COVID-19, how to prepare for similar emergencies in the future, how to create an emergency account, and how to save to achieve your dreams. Be money smart. Be part of the Banking and Financial Services Awareness Month. Visit www.yourmoneycan.or.ug. Brought to you by the Uganda Institute of Banking and Financial Services, UIBFS. Your money can enable you to live a better life only when you budget and save before you spend. Act now. Learn how to manage your income and expenditure correctly at the Banking Financial Services Awareness Month. Meet the financial experts. Learn how to deal with financial hardships like those caused by COVID-19. Be money smart. Be part of the Banking and Financial Services Awareness Month. Visit www.yourmoneycan.or.ug. Brought to you by the Uganda Institute of Banking and Financial Services, UIBFS.